Welcome to StockOdds Odds and End podcast. I'm Dave Singh here with Rob Friesen, getting ready for the week ahead. Good evening, Rob. How's everything?
Not too bad, thank you. Lots to discuss on the earnings front. I understand we had an interesting Friday with kind of I call it to me it's the real start of earnings season is when the big banks report, and we had J.P. Morgan, knock it out of the park there, and Citi and Wells Fargo, Bank of America, PNC, BLK, they were reporting. Bank was up 3.36, Citi up 4.78, JP Morgan up 7.55. That was just on Friday alone. So really big move. And it helped lift the financials. Visa, MasterCard, American Express, PayPal, all up. Asset management was up. Capital markets were up, except for Schwab. And insurance was down. PGR, CB, Travelers were down. Some international banks were down. Some of financial data providers, were kind of flat to break even. We had NVIDIA did pretty well on Friday, up 1.11%. Google up 1.34%. Now, I just want to rattle off for the week here how things went. Again, the financial services area did really well, except for insurance for the week. And we also had Meta up 2.49% for the week. We had Lilly and Merck up more so than Johnny and Pfizer. Pfizer was actually down for the week. In the industrial area, we had a few, like Raytheon was up 3.53, but Boeing was down 4.57. A lot of that on Friday, I think, too. Caterpillar was up 6.94. So that usually responds to recession implications negatively, but this week it did fine, 6.94%. Deere was up. We had the oils hanging in there again. Chevron was up 2.86 for the week. Conoco 2.11%. Hess 5.71. The consumer defensive, most of them were down. Walmart was down. Target was down 2.77. Even Procter & Gamble was down. And restaurants, Starbucks was up 2.67, McDonald's 2.15. In the footwear area, Nike, we did a remarkable 4.77%. Home Depot and Lowe's slightly positive at 1.24 and 1.82. I know we had some good movement the week before in like Intel and some of the semis, but Intel was down 2.80 for the week. Microsoft down for the week 1.87, and Apple was just above unchanged at 0.33%. So that kind of gives you a picture of what's happened. And now take us into some of the upcoming earnings. What are we expecting this week, since it's getting to be rolling into not the heaviest week of earnings, but starting to build for sure.
Yeah, and there's lots in financials as well. So we have Charles Schwab, State Street, M&T Bank, JB Hunt on Monday. Tuesday, there's Netflix. That'll be a mover as well. Things like Bank of America, Goldman Sachs, Johnson & Johnson, Lockheed Martin, United Airlines. Wednesday, Tesla. That's going to be watched as well. Abbott Labs, Ally Financial, Baker Hughes, Crown Castle. I mean, there's so many here. And not just in financials, LBS, Consumer Discretionary, Travelers, U.S. Bank Corp. And Thursday, a big one is American Express. That'll also give light as to how the consumer or the high-end consumer is doing. We've got AT&T, Nucor. There's just a lot. Xerox. So across the board, it's not just NASDAQ or anything. And Friday, a couple more. Procter & Gamble and Slob, SLB for energy. And then in terms of economic reports, Monday there is a manufacturing report, Empire State Manufacturing. Tuesday, housing starts and building permits. Then Wednesday at 2 p.m. Eastern, there's the release of the Fed Beige Book. It's always going to give some more insight into how the Fed's thinking. And then Thursday, jobless claims, initial jobless claims, and Friday, services PMI and manufacturing PMI. So there's still a little bit of macroeconomic stuff in the mix there, but really going to be heavy on earnings.
Okay. As far as the futures, what they're doing now, so the Dow Jones futures are up 64 points or 0.19%, and they're sitting, pretty close to this year's high so far. So we've really retraced through the month of March and just April so far. We've continued to build and head back to kind of where we came from at the beginning of the year here. Let me just see. Well, I mean, we're higher than the beginning of the year, but like I would say, the January 17th high, and then again on February 14th for the Dow Jones, we're not far off from that. We're within spitting distance of that. Same thing on the S&P 500 futures here. We had February 2nd was our high, and that was at 4208.50, and we're sitting as of Friday's high there was 4189. We're up 8.25 points or 0.2% on the S&P 500 futures. NASDAQ, now this is where it actually made a new high for the year on April the 4th, and that was 13,348 on the NASDAQ 100 futures, and we're sitting just below that. So that market has done the best for the year so far. And then the Russell is really, quite sad looking in the sense that it's down in the, way down below its February. What day was that? That was February 2nd as well, that it made a high at 2,016.90, and you're sitting down at 1797 now. It is up 5.4 or 0.3%. So across the board, they're all up slightly, and the VIX is down 0.83% right now, so almost 1%. The interesting thing about the VIX is it's just sitting on its February the 2nd low, which coincides with the February 2nd high of the S&P. Now, I went back and looked at going back in history all the way to 2006, and it looks like many Aprils and Mays are actually the lowest volatility periods of the year. So even though we're have earnings season and so on, the exception to that would have been April of 2022, where the VIX shot up. As you know, the market was kind of pulling back substantially in 2022. That was one of the months that the VIX shot up a lot. And then, of course, in 2020, when we had COVID, the VIX shot up high in March, and it pulled back through April. So it was declining, but it was still quite elevated. But other than those 2 years, if you look at even 2021, the low month almost in the VIX was in April, and many years back to 2006, April and May were the lowest. So there is this potential that the VIX does decline from where it's at 1820 now. We're sitting at 1820. It could head down towards 15, by the end of May. It all depends on, any other macro themes or something like that. So what does that mean? A lower VIX does potentially support the market, meaning the market could rise and actually, take out that high that we set earlier this year. That's entirely possible. But I also find that there's this backdrop of a lot of, articles, things that have been talked about, us moving lower from this point. heading into a serious correction. And one of those articles relates to sort of the liquidity that's available in support of equities after tax season. That might be why we often have the sell in May and go away theme. So there's that, I guess, aspect of a potential decline from this point. There's actually something else that an article that I found interesting was it was Nardelli talking about some things on coast to coast. He said, we got Walmart not only laying people off, closing stores, we got Accenture laying people off, we got Amazon closing distribution centers. So I think there's a tremendous mixed message, Nardelli said. The former CEO continued saying that the complexity of the US economy is different than anything he has seen in his 52 years. The complexity of the US economy. So when I hear that, what I think about is there's so much different messaging, there's so many different problems to solve, there's so many different aspects of what the market's trying to factor in versus what the Fed's saying versus what the politicians have to deal with the debt ceiling and things like that. We've got the Ukraine-Russia situation still in play. We've got the Taiwan thing. We've got unsettled activity in the Middle East. And so the economy is facing a lot of these pressures, plus you've got the geopolitical environment. And what that could mean for us is this back and forth action of the market, right? Expecting a lot of chop, expecting a lot of mean reversion, expecting, lack of conviction on either side, lack of trends for long sustained periods of time. We just had a pretty good one coming off of the banking crisis lows. But, now that we've risen up and we could be going into an event where there is less liquidity and there is potentially the sell in May and go away. So we don't know what's going to happen, but we can expect, trading triggers, catalysts, events, and activity that to me is largely distribution, chop, reverses, things like that. So I like the environment that we have and that we're potentially going to continue in for what we do, which is relationship-based trading, which is basket trading, and so on. So, historically, from this arena of basket trading, we've seen a lot of samples of 0.1% return on capital. That doesn't sound like a lot. But if you drop the hammer every day and you persist at improving, and Dave and I were talking a bit earlier about approaching the market each day with a risk on kind of framework with your list selection. So you've actually purposely selected things that would fit a risk on model. Also, you would have a sample that would be a risk off model. And then you would have something that would be quite neutral, very quantitative, very unassuming in terms of direction of the market at all. Obviously, a risk on model assumes, an upward direction, and a risk off model assumes a downward direction. But rather than, have direct exposure to just only buying or selling the futures, or the SPY, something like that, you would be selecting a list of equities that most represents the things that would be accumulated under a risk-on environment. And likewise, with a risk-off environment, you would be selecting those things that respond better to that. They're maybe more defensive and so on. So you'd be selling riskier assets and buying more defensive assets. So you don't have to choose a side. Like, you don't have to open yourself up to that. You can be very quantitative in the sense of being balanced in your sectors and, having just a really good variety, a good mix, a good sort of neutral position in everything that you're doing. and that's fine. But there are days where you possibly could take advantage of what the market's already telling you, right? Take advantage of some buy side activity. So we could have that tomorrow, and possibly for this week. It's possible. We're going into mid-month seasonality. So is there any candidates that you see in terms of like what sectors, Dave, are best represented by mid-month seasonality strength, and which ones are best representing mid-month weakness? What do you see?
Yeah, from the long side, industrials, XLI, XOP, discretionary materials, regional banks, KRE. And then on the short side, there's oil, some of the ARK funds, ARKK, XBI, so biotech, IBB, and retail, XRT. So those are the ETFs that are most favored. And some of the individual stocks that are examples would be like Qualcomm from the long side, Intuitive Surgical, American Express. On the short side, some of the meme stocks, GameStop, Snap, Square. So it is a bit more quality long, and some of the higher beta stuff short. And in terms of the mid-month seasonality, the S&P is expected to do minus 0.02, so pretty much flat. The NASDAQ a little bit worse, and same with the small cap. So it's not a very eventful mid-month seasonality for April, but there is some.
Okay. Yeah. So if you take a look at maybe a lackluster week in terms of the market, it's not one of those staring in your face strong or weak periods of time, but we've just had a reasonable run here for the last couple of weeks, and we're sitting into obviously this tax season influence, right? So they just stress that there seems to be a lot less liquidity in the markets in the weeks following. So I always thought that April was a reasonably performing month, but it's not historically that way. It's actually slightly down for the month, which is interesting from what I perceived before looking at the seasonality, right? So looking at where we are with the dollar is going to be very important because we were having this nice pullback on the dollar, and then we had a move on Friday that launched it back up. And right now we're sitting up slightly at 0.13. So it's hard to say whether that will continue tomorrow or not. But I think if we get a follow through to the upside, then just be careful of your basic materials and your gold and stuff like that, because gold was really impacted on Friday. Let's see, bringing it up here. Gold took out all of Thursday's movement up, and some of Wednesday as well. Actually took out Wednesday, went almost to the low of Tuesday. So very substantial move, and it'll be important because it's still above this $2,000 level here. It's at 2017. So it's kind of sandwiched between 2050 and 2000. So a break, either way will be important. Let's look at energy. Energy's been stable after it had the OPEC announcement of the cut, which is supposed to come in May, but it's been stable at the $80 level. And then it actually rose a little bit towards 83, sitting currently at 82.60. So we haven't been able to fill that gap from Monday's big move there, and it's building on it slightly. So oil, we may have seen the lows might be in for this year, because normally, Dave, we always have a bit of a rally in May and June in oil because of the holiday sort of summer demand and stuff like that. So then it tapers off, towards August and stuff like that. So it could be we could see another bit of that too, and that might take us up towards the $90 area, especially if the cuts actually start in May like they're supposed to. So prepare for that. A little more expensive gas at the pump again. You don't want to head back there, Dave, do you? California, back to what?
We were like $8 at one point.
Yeah, that was the highest, $8. What are you at now?
About $5.50 in most places.
Yeah. Well, I mean, it could in the summer head back towards maybe $6.50 or $7 or something. You never know.
Yep.
What else? What the bonds are doing here? Because that was the bonds have been trying to figure this FOMC thing out. So we had a big run up into the first week of April. That was the banking crisis sort of saying to us that, well, the Fed probably won't be able to be that aggressive under these situations, and potentially, May might be the last hike for this year. And then this last week here, we started pulling back again, which meant that yields were rising. And they're saying, well, Fed still has to stay committed to raising rates, so May may not be the last one. And inflation is still a bit of a problem out there, even though the pace of the inflation declined. And some of the job, news said that, things are working in terms of slowing the economy. But the market is trying to, I think, get ahead of itself here and assuming that the Feds would have to be dovish and go easy on us. But not the case. So their bonds are pulling back, which means rates are rising, which meant that the dollar, didn't continue to descend, and Friday popped up a little bit there. So that's where we're sitting. Yeah, I mean, what do you got in economic news this week? Anything?
Yeah, we just had initial jobless claims. So on Monday we have Empire State Manufacturing and then home builder confidence. So some housing information. Tuesday housing starts, building permits. Wednesday beige book. Thursday initial jobless claims and existing home sales. And then Friday is the U.S. services PMI and manufacturing PMI. So yeah, a bit of employment data and housing seems to be heavier in those themes.
Okay. So it looks like China's pumping in more liquidity while keeping key rate on hold. That might be positive for Chinese stocks. Okay. I don't understand things like this. Says business confidence up sharply at the biggest firms, and then office space occupancy remains around 50% across U.S. metros. So 50% off occupancy in the business office space, and yet business confidence is up sharply. Okay. So again, this goes back to my theme of a lot of mixed messaging and a lot of confusing data points in U.S. economics, which I think is ultimately good for trading, right? Anything you have left?
No, I just think this AI would be some kind of swan, gray, black, white, because there was some Goldman Sachs report too that 300 million jobs already can be identified as being replaced instantly by some of the AI stuff that's going on, right? So this could accelerate the less need for actual employment worldwide, like very rapidly, and that could be extremely deflationary, right? So we went from a period of super high inflation, we could go to super deflation. I mean, who knows?
Well, that's a good point. It's something that we've mentioned on the show before about it wouldn't surprise us to have a dramatic pivot. What tends to bother me with monetary policy is that the decisions that are made are based on what we know is currently happening or has happened in the past. So the data points are quite laggy in that sense. I mean, even our leading indicators and economic reports are like, well, this was March's numbers. I mean, it's not May's numbers because we haven't got there yet. Forward looking in that sense, it's only past looking. And so then we manipulate money flow and monetary policy and things like that. And what if that just made it worse? Like, what if it had been left alone to be self-regulating, self-balancing, rather than interfering? So I think the interfering process, if you get it wrong, could mean that where you suddenly have unintended consequences and you go from, they're trying to get to a 2% inflation target, which they keep talking about, and they press the pedal in that direction too hard, and all of a sudden, you're back into serious deflation. And there's pros and cons for both in a sense, but probably what's ultimately worse is a serious deflationary environment, because then people stop buying stuff. Because if you knew that, that nice Jag that you wanted to buy was going to be half price next year, why would you buy it this year? You know what I mean?
Yeah.
I mean, that's a dramatic example, but I only speak to those Jag drivers.
Yeah, you see it in TVs every year too, right? Like huge TVs, like, well, wait 6 more months and it'll be half the price too. Same principle.
All right. Well, that's good thought there. And definitely, guys, watch the dollar. Very important. Be careful of your small cap space. It seems to be one where they, if you do get a risk on day, they really like to buy these small caps. But if the market is in a serious negative sentiment and declining, then a lot of that stuff just gets run over. And hedging with IWM, you really have to move towards beta hedging, because dollar to dollar hedging doesn't help you on those big down days. So you got to be prepared for that if you're going to play in the small cap space. It's a great place to play for when you get those risk on days, or when you get a gap down on the market. It works well too, because of the higher beta volatility of the small caps. But if they gap up a lot and they were to pull back from that point, that's a risk. If they open down just slightly and the sentiment's really bad and they sell off for the whole day, and it'll end up being down 3, 4, 5% on average, you're gonna find it hard to make money if you don't stay on top of that. So small caps, if you're going to play in that space, they require more finesse, more art form, more limit order consideration, more hedging dynamics, capital changes, taking advantage of the moves, taking advantage of the type of day. So if you're not comfortable with that, then just continue to live in the S&P 500 area of the more liquid stocks. It's more efficient, but also you don't run that higher element of risk. Okay. All right, we'll close it off. Thanks for your time,
All right.
Dave.
Good luck. Thanks.